It's an understatement to say that gaming has come a long way. Not to sound like an old person, but back in my day, video games were two-dimensional, incredibly pixelated, and the only way to kill your enemy was to jump on their head. If the game stopped working, you had to run over to the console, pop out the game, blow on it, and then stick it back in. Nowadays, kids play complex games with breathtaking graphics and lightning-fast frame rates, live with players all around the world. The gaming industry has always been a fast-growing, highly innovative sector. With the advent of cloud computing, the metaverse, virtual reality, augmented reality, streaming, esports, tablets, and smartphones, this industry is primed to continue accelerating. As savvy investors, we want to position ourselves to profit off of this growth. ETFs allow us to get diversified exposure to the growth of the gaming sector as a whole, without having to deal with the stress of picking individual stocks that may or may not succeed. Today, we will be looking at some of the best gaming ETFs on the market. For each ETF, we will look at topics such as portfolio composition, regional exposure, market cap exposure, top holdings, cost, and performance. At the end, I'll give my own opinion, for those that care about my opinion. If at any point you decide to like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, if you want some free stuff, feel free to lurk below and check out the links in the description. You can get free stocks and also a free $30 to sign up with Rakuten, a site where you can earn cash back on everyday purchases. Stuff you buy anyway, but you get money back. What's not to like? Without further ado, let's get started. On today's list, we have ESPO by VanEck, Hero by Murray Asset Global Investments, Nerd by Roundhill Investments, and GAMR by Wedbush. ESPO is the largest in terms of assets under management, with Hero in second place. So let's look at regional exposure. The main thing to think about here is, do you want more U.S. exposure, or do you value the added diversification that comes with owning international equities? The U.S. market has historically outperformed international markets, but this is no guarantee in the future. Another thing to think about is Chinese exposure. Investing in Chinese companies is a real wild card. You just don't know what you're going to get from the Chinese government. So there's some real uncertainty there, and the market hates uncertainty. So some call China uninvestable, but some investors are fine with this added risk, and with higher risk can come higher reward. ESPO has the highest U.S. exposure at over 40%. Nerd has the highest Chinese exposure at 20%. GAMR has the lowest Chinese exposure at under 10%. Let's look at market cap exposure. ESPO and Hero lean more large cap than Nerd and GAMR, with ESPO being the most large cap. Nerd and GAMR lean more mid cap, with Nerd being the most balanced across market caps, and GAMR having the highest concentrations of mids and smalls. Small caps have historically outperformed large caps over time. However, while they can provide greater opportunities for growth, they tend to be riskier and more volatile. Large caps are often seen as safer, transparent, stable, and consistent, with larger resources to better withstand tough times. But, of course, these are generalizations. Large is not always safe, small is not always risky. Let's look at industry exposure. I would say that the ETFs with a higher percentage of companies in the entertainment category could be seen as more pure gaming plays. These are going to be your Nintendos, Activisions, Corsairs, Electronic Arts. What I'm saying is there's a lot that goes into the gaming sector, and a lot of different companies power it. For instance, technology hardware companies, software companies, semiconductor companies, these all power the gaming industry, but they also power many other industries. You might value the added diversification that this brings, but conversely, you also might want to focus more on the gaming companies. After all, we are paying a higher expense ratio for these ETFs, because they are specialty ETFs. Hero has the highest concentration of companies in the entertainment category at around 90%. The rest are between 50 and 60%. So let's dig a little deeper on that and look at the top holdings and also the quantity of holdings. GAMR has the most holdings at 100. The rest are hovering around 30 to 50. Ranking diversification is tough because it's the product of a multivariable equation filled with many of the factors that we discussed so far. Geographic exposure, market cap exposure, industry exposure, number of holdings. GAMR also has the lowest concentration in the top 10 holdings. Taking everything into account, I'd be willing to stick my neck out and say that GAMR is the most diversified in this space. But keep in mind that I put the word diversified in air quotes because these are all industry-specific ETFs. And from a macro standpoint, they're all inherently non-diversified compared to your broad market ETFs. Semiconductor names NVIDIA and AMD make a showing in the top 10 of ESPO. Your typical gaming names Activision, Nintendo, and Electronic Arts make a showing in the top 10 of Hero. Chinese names Tencent and Sea make a showing in the top 10 of Nerd. Note that GameStop is present in the top 10 of GAMR. If you have been following the whole GameStop meme stock saga and the apes over at Wall Street bets on Reddit, you may have strong feelings on this one way or another. I approach Wall Street bets with the same fascination that I have when I go to the zoo and see the actual apes on display. But I personally don't want GameStop in my ETFs. Next, let's look at cost, specifically the expense ratio of each. This being the annual cost that we have to pay for management. ESPO charges 55 basis points. Hero and Nerd both charge 50 basis points, and the greedy savages that run GAMR charge 75 basis points. I'm kidding, but I'm also serious. So Hero and Nerd tie for the win on expense ratio, but even still, 50 basis points is not exactly dirt cheap. Granted, it's unfair to compare them to S&P 500 ETF issuers that are down around 3 to 4 basis points. These gaming ETFs are specialty ETFs that focus on a niche part of the economy, and therefore they can demand more of a premium. Anyone that buys these specialty ETFs is hoping for excess returns that will blow the S&P out of the water. So at the same time, we do have to be careful to not step over dollars to pick up pennies. But small differences in costs can add up to large differences over time. You don't really think about it in the bull market, but it can be a real bummer in a bear market when your portfolio goes down or sideways and you're getting eaten into by fees. This calculator shows the concept. If you invest $6,000 a year into two ETFs, one with a 50 basis point expense ratio and one with a 75 basis point expense ratio, assuming equal returns of 10%, the 75 basis point expense ratio will cost you $151,000 more over 40 years. If you really want to feel the hurt, swap the 50 basis points for 3 basis points. Then the difference is almost $500,000. But again, this assumes equal returns, which is a big assumption. Sure, gaming ETFs will trade somewhat similarly to each other, but they will not trade like the S&P. If you get outperformance, none of this matters. But at the end of the day, cost is the only variable that you can control. So sometimes we just have to focus on what we can control. Up next is performance. So in summary, these ETFs skyrocketed in 2020 when everyone had nothing else to do during Rona except sit at home all day and play video games. This, of course, in tandem with the loose monetary policy of the Federal Reserve dropping interest rates to near zero in an attempt to stimulate the economy. When interest rates fall significantly, consumers and businesses increase spending, causing stock prices to rise, particularly growth stocks, which are particularly sensitive to interest rate hikes. The stocks in these ETFs skew very much towards the growth side. Once it was clear that inflation was getting out of hand, the Federal Reserve had to hike rates back up again. This, in tandem with tough year-over-year comps and supply chain issues, caused these ETFs to crash back down. With that said, some of these ETFs did better than others, or at least held up better than others. We only have 1 year data for these ETFs because some are too new. They're all down at least 25% year over year, with Nerd being down almost 40%. ESPO went up 145% from pandemic lows to February 2021 highs, and then back down 42%. Similarly, Hero went up 164% and then down 43%. Nerd went up 212% and then back down 57%. GAMR went up 189% and then down 45%. At the very least, these numbers give you an idea of how volatile each ETF is. For instance, we can expect Nerd to fly the highest in a bull market, but get hit the hardest in a bear market. Which brings us to our next point, risk-adjusted returns. To analyze risk and return, we can look at Sharpe ratio. The Sharpe ratio adjusts the portfolio's past performance or expected future performance for the excess risk that was taken by the investor. A high Sharpe ratio is good when compared to similar portfolios or funds with lower returns. However, the Sharpe ratio uses volatility to determine risk, which is not an unreasonable assumption, but also not a perfect comparison. Unfortunately, we don't have data for Hero, but of the three, ESPO has the best Sharpe ratio at 0.78. Because of its wild swings, Nerd comes in last at 0.26. Just for reference, the broad market has a Sharpe ratio of 0.66. Alright, so what are my thoughts? I like the gaming industry in general, for all the reasons I listed at the beginning of this video. There's a lot of innovation in this space, and a lot of talented engineers that want to work in this field because it's fun and it's likely something that they're passionate about. I am, however, a big stickler on ETF management fees. I usually like my ETFs to be down around 0 to 15 basis points, but you simply won't find most specialty ETFs down in that range. And when you look at the graphs, there's definitely a lot of volatility in this space. For that reason, I could never have ETFs like this as the core of my portfolio, but maybe something to round out the edges. But when you look at the run they had in 2020, it gives you an idea as what is possible for these ETFs in a bull market. Just a little bit can go a long way, but you certainly pay for it in a risk-off bear market like what we've seen recently. Honestly, I'm killing myself by making this video now instead of when these ETFs were rallying to the moon, just in terms of the amount of views and attention that this video would get in a bull market versus a bear market. That's the sad thing about investing. Everyone wants to buy when prices are sky high and moving up, but nobody wants to touch these ETFs when they're down significantly off their highs. To be successful in the market, you really do have to be a contrarian sometimes. Like Warren Buffett says, be greedy when others are fearful, be fearful when others are greedy. As far as the ETFs themselves, I don't currently own any of them, but could potentially open a small position in the future. GAMR is the most diversified, but the expense ratio is notably higher than the rest. Nerd has a little bit more Chinese exposure than I would prefer. Hero serves as the most pure gaming play. ESPO is a bit more well-rounded. I would say that I like ESPO the best for this reason, and it has the highest concentration of US companies. But if I wanted to be a bit more targeted and save 5 basis points on expense ratio, I would put Hero as a close second. But if you found this helpful, consider hitting the like button and subscribe for more content like this. Again, also consider checking out the links down below. Currently down there, you can get 2 free stocks with Webull, potentially valued at $2,300, $30 with M1 Finance, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just for entertainment purposes only. So thanks, and I'll see you in the next video.